Now it's time to welcome our next guest to the show, Mr. Wes Wood. Wes is the founder and president of Wood Financial Group in Nashville, Tennessee. He has more than 15 years of experience in business administration and investment management. He's built his career on helping people grow and protect their wealth. Most importantly, Wes is another good friend of the income generation. Wes, thanks for being back on the show.
Thank you, Dave. Thanks for having me.
So you heard Steve Forbes say, hey, with the economy, we could still have another good year or two in the economy. He had projected last time he was on the show that we could get to 3.5%, 4% GDP growth. He's still pretty optimistic. He thinks people, all the pessimists they're just basically saying, look, it's been 10 years, we're due for a recession. What are your thoughts?
Sure. Well, Dave, I believe there could be another year or so left in this economy. We're still seeing some positive growth. Most forecasts are saying we're going to see somewhere in the 2 to 3% range, maybe an average of 2.5% on the GDP. Past a year or two, I think, is getting a little bit carried away. I would say maybe a good year this year in the economy, but we're probably going to see some slowing going into perhaps 2020 and especially 2021.
Yeah, so you're kind of sort of in line with Steve Forbes, maybe not quite as optimistic for the next year. After that, who knows? Of course, where some of his optimism comes in the 30 seconds or so we have left in the segment, is he thinks that the Democrats are taking such a radical stance over to the left that he feels as though it's almost going to be a shoo-in for the president to get reelected in 2020. If that happens, do you think that'll change things and help the markets and the economy to continue to grow for longer?
Well, if Trump gets reelected, that's definitely a good thing for the economy. But we would need to remember that we've been on a great rally. We've been on a great economic boom for the last 10 years or so. And, at some point, these things begin to slow. This is one of the longest expansionary periods we've ever had. And if you look at the history, and here we are kind of, we're running out of steam.
It sounds like you're
we're
saying,
not hitting those 3 to 4%.
It sounds like you're saying you're in the camp that says we're overdue, it's got to happen. So Wes, stay with us. We need to take a quick break. We'll be right back here on The Income Generation. Welcome back to The Income Generation. I'm David Scranton, and we're here with our good friend Wes Wood from Nashville, Tennessee. Wes,
Thank you, Dave.
when you were on the show just a little while ago, and we talked about what we thought was going to happen in this year with the stock market, you were moderately pessimistic. You kind of said what you said today, that we think we'll get some growth this year in the actual economy. But it doesn't mean the stock market's going to go up this year. In fact, the stock market very well could be out of steam. Has anything changed in the last 5 or 6 weeks that would cause you to change your stance on that?
Not so much. I was a little bit more pessimistic at the end of the year after the Federal Reserve was really bullish as far as increasing interest rates.
Right.
And a lot of people believe that rates are going to go up as a matter of 3 to 4 times in 2019, which unfortunately could create a major problem and perhaps a recessionary environment, really drag the market down. Luckily, the Fed made a U-turn, and they're saying we're not going to do that. We're a little bit more pessimistic. We're concerned that if we increase interest rates too quickly, it could create a recession. So they've dialed that back, which I think is a good thing. But however, it's been so long. We're pretty much overdue for some type of correction, perhaps a crash. But with the Fed being a little bit more on the side of being more concerned with the markets and the economy, that definitely helps some, which is why I believe instead of maybe 2019 seeing some type of correction or crash, it may be pushed out a little bit further. But still, we can't continue just pumping all this quantitative easing into the markets. At some point, we have to get rid of what we have on the balance sheets, increase interest rates, and get more into a real world economy.
Do we have to, Wes, get back to reality? This has been too much fun over the last 10 years as things have recovered. And you heard Steve Forbes, who turned around and said he thinks, we will get a deal with China. Now the Fed's out of the way. If they stay out of the way, that's good. That was his biggest concern, is whether the Fed stays out of the way. Right. No more government shutdown, let's say. The market could go up. So we could be wrong. Steve could be right. But in the 30 seconds we have left, tell our viewers this. The probabilities. What are the probabilities? Is the upside worth the downside, in your opinion, with how the markets look right now and how the economy looks?
Well, Dave, with the stock market, I think there's more downside, unfortunately, than there is upside. Think about the stock market as a form of gambling. You're hoping for growth in the markets whenever you invest in it. It's a form of gambling, and if you buy stocks, you're hoping for some growth. But also, unfortunately, that growth can turn into some losses. So imagine, as a form of gambling, if you walked into a casino and you put money down and you had a 50% chance of winning and a 50% chance of losing. The upside, you may get an extra 10% on your money, but the downside could be 30 to 40%. I think when you think about the market as far as gambling,
I'm not taking that bet. Sorry, Wes. I'm not going to the casino with you if that's the deal.
Exactly.
That's a great analogy. Wonderful analogy. Thank you for being on the show, Wes. We really appreciate it.